Tonight, we are going to witness the most anticipated match in the history for the heavyweight championship of the world. Are you ready? Are you ready? Ladies and gentlemen, let's get ready to rumble!
Another lifetime? Man, probably could have been a boxer. You don't believe me? You know what? You're probably right. Let me get these off. What's going on, YouTube? It's your favorite headless YouTuber back at it again with a brand new video. And I promise you're not going to want to miss this one. Before we get into today's video, I want to lead off with a motivational quote. Nobody ever sees the vision until you complete the mission. So make sure you always see it through and remain consistent. Now, in today's video, we'll be talking about the difference between a trader and an investor, as well as some common misconceptions between both. A lot of times, these two terms are used interchangeably, and of course, no crime is committed in doing so. However, I believe it is very important to be able to distinguish between the two. As always, for sticking around with me today, later in the video, I'll be giving my 3 stocks to buy this week. Not 1, not 2, but 3 plays that I believe will be profitable this week. If you want us to post more videos more often, do us a favor and subscribe to the channel and turn on notifications so you don't miss out on any new content. Without further ado, let's get to it. First things first, let's talk about what exactly it means to invest when it comes to the stock market. It means to buy shares of a company with the expectation to hold for multiple years, typically 3 to 5. And in certain circumstances, investors may never look to sell their position. Investors look for larger returns over longer periods of time. On the other hand, we have trading. Trading means to take advantage of both rising and falling markets by buying and selling shares of a company over shorter periods of time. Traders are more inclined to take the smaller, more frequent profits. The most common types of traders are day traders and swing traders. Day traders buy and sell shares multiple times within the same day, never holding positions overnight. Swing traders, on the other hand, have a more flexible time horizon. A swing trader can look to enter and exit positions or buy and sell shares over a few days, weeks, or months, depending on the swing trader's strategy and preference. Now, let's get into some key differences between the investor and the trader. These differences can be broken down into 3 categories: timing, risk, and approach. Let's talk about timing. As we've already discussed, the timing of the investor and the trader are very different. The investor has a long-term time horizon, holding positions several years before selling, and sometimes not looking to sell at all. The trader has a much shorter time horizon, typically only holding positions for less than a year and sometimes only a matter of minutes. Now, let's move on to risk. As you've probably already guessed, the investor, in theory, takes on much less risk on his positions than the trader does. This is because time is on the side of the investor more than it is for the trader. While markets no doubt fluctuate, investors will ride out the downtrends with the expectation that prices will rebound and any losses incurred will eventually be recovered. Traders seek to make profits within a specified period of time and often use things like protective stop loss orders to automatically close out losing positions at a predetermined price level. In other words, traders are much less likely to ride out a losing position and instead will cut their losses and find a better entry or another trade to enter. The best advice I can give to both traders and investors is just to know when to take an L. Losses are just a part of the game, and being able to recognize when you're wrong is going to make all the difference in your success in the markets. On to the third key difference, which is approach. Trading typically requires you to be a lot more active in the markets because you have to monitor your positions and always be on the lookout for new opportunities to take advantage of in the market. Investors can be a lot more hands-off with their positions because they have a longer time horizon and are less likely to react to small fluctuations in a stock's price. Investors use what's called fundamental analysis to make most of their decisions on which companies to buy into. This means they look into things like the company's balance sheet, financial statements, management structure, and many more aspects of the actual business. Traders, on the other hand, can trade shares of a company without needing to know anything about what the company does, because most of a trader's decisions come from what is called technical analysis, or in simpler terms, stock charting. Using various combinations of indicators, traders analyze a stock's historic price patterns to determine where a company's stock price is headed. Sounds complicated, I know, but I assure you that it is much easier than most people realize. We will cover some charting techniques in future videos, but we go so much more in depth in the Vault's Market Mastery course, which you can find a link for in the description below. Now, before we continue, if you're enjoying this video and want us to make more videos more often, as always, be sure to hit that like button below, subscribe to the channel, also comment below your thoughts and questions. Let us know what you want to see covered in future videos. Common misconceptions. Usually when you look up anything about the stock market or a stock trader, you're likely to get an image similar to this. A nice office setup with a nice desk and a gazillion screens, all with stock charts and other nonsense on them. While there are some that still feel the need for a setup like this, the truth is we've advanced well beyond this, and now you can be a successful trader with just a laptop, a phone, and a good Wi-Fi network. And I'm sorry to be the one to break it to you, but no, sitting outside of your local McDonald's does not count as good Wi-Fi. The most common misconceptions about trading I will talk about today are that trading the stock market is no different than gambling in a casino, and that trading requires too much time to be successful. First, let's dive into the idea that trading is like gambling. I couldn't disagree more with this belief because trading requires preparation, skill, and knowledge, whereas gambling does not. Trading and investing can become gambling without the proper knowledge and education on what to do and how to do it. Successful traders treat their trading like a business, planning every move and always looking to improve upon mistakes. Now, to those that believe that trading is too time consuming, here's my rebuttal. Limit orders and stop losses. When you place a limit order or stop loss order, you're telling your broker you don't want the market price or the current price at which the stock is trading. Instead, you want your order to be executed once the stock rises or falls to a price that you specify. A limit order is placed to buy a stock at a specific price. For example, if XYZ stock is currently priced at $100, but you feel that it is too much and you want to buy it at $90 or less, you can set a limit order for $90 that won't be filled unless the price falls to or below $90. A stop loss, on the other hand, is placed to sell a stock at a specific price. Using the same example, let's say that XYZ stock fell to 90 and your limit order filled or executed. So now you own shares of XYZ at $90 per share. Now you want to protect your position with a stop loss set at $85, meaning if XYZ falls to $85, your broker will automatically sell you out of your position before it falls any lower. That way, if XYZ falls to $80, $70, or even $50, you'll be safe from losing any more money. As you can see now, with things like stop losses and limit orders, your trading can be put on autopilot, where you buy and sell shares at your preferred prices automatically. Now, there are several other order types that cater to different preferences and strategies and also give that sense of autopilot trading. Let us know in the comments section if you want a video covering the different order types. So it all boils down to which is better. My answer is neither. Both are really great in my opinion. This isn't a black and white situation of this or that. I believe that it benefits you to be able to be both an investor and a trader, because with the right education and knowledge, you stand to benefit from both archetypes. Here inside the Vault, we employ both trading and investing in our mastery strategies. Successful traders are able to make money and grow their wealth faster, while investors have the advantages of larger and safer returns, as well as passive income through things like dividends. So why not employ both strategies to your advantage? So now begs the question, which one are you? Do you prefer one over the other, or do both pique your interest? Do you like the idea of quicker returns, or maybe you value longevity and patience? Whichever side you lean more towards, be sure you learn the ins and outs of the strategy so you can take advantage of all the benefits it has to offer. Bonus time! Full disclosure, we inside the Vault trade options and invest in shares. So unless otherwise specified, Any trades or stocks we alert on the channel are options plays. We suggest that you learn what options are and how to trade them before participating in any options trading. If you want us to cover that topic in a future video, you know what to do. Be sure to comment that suggestion below. Also, if you like all of our weekly and monthly stock alerts, along with full detailed insight behind each alert, click the link below to become a VIP member today. Now, for our 3 stocks to buy this week. The first stock is Synopsys Inc., or ticker symbol SNPS. According to our analysis, Synopsys is overdue for a small correction and is likely to fall this week to around $312 and possibly even lower. We will be entering put positions with September 24th expiration dates or later. Next up is Netflix, ticker symbol NFLX. After a great week from Netflix, we expect Netflix to cool off this week to around $542. We'll be entering put positions with a September 24th expiration date or later. And finally, we have Microsoft, or ticker symbol MSFT. Like Synopsys and Netflix, we believe Microsoft is overdue for a pullback to around $300. And we will be entering put positions, you guessed it, with the September 24th expiration date or later. As always, do your own due diligence with every investment and make sure it fits your criteria. And of course, trade or invest responsibly. So that'll do it for today's video. If you've enjoyed this video and want us to make more videos more often, you know what to do. Be sure to hit that thumbs up button below and subscribe to the channel if you haven't already. Also, comment below your thoughts and questions to let us know how we can continue to improve the channel for you. This channel and all of its content is made for you. Thank you for watching this video, and I'll see you in the next one.